All right. That's a WhatsApp number and email ID flashing on your screen. And today, to answer all of your queries, I have with me Anil Rego, founder and CEO of Right Horizons. And Anil, before I take up our viewer queries, we'll be taking up Dev's query. Just before that, since in the previous segment I was talking about how people with no HRA are shifting to the new tax regime where they have an added benefit of NPS going on. I just want your take, on these aspects, because there has to be a certain kind of criteria why you should be considering shifting to the new tax regime. Strategic financial planning is one of those very crucial reasons. Now, according to you, what strategies can employees adopt to maximize the benefit, in terms of getting enrolled as per the new tax regime? Because it's not only the money in your hand that you're getting, if you've been in the old tax regime, you are used to forced saving, it gave us some kind of a discipline. How do you ensure that you stick to this when you are in the new tax regime?
Yeah, so I think one of the most unfortunate things about the new tax regime is that it doesn't incentivize savings. Okay, and if you step back to a lot of maybe our generation and earlier, the current thing and earlier, right, where we had tax savings, and a good reason for us to start investments was always that tax. Okay, so all of us got introduced to mutual funds through the ELSS scheme, right? And then we got introduced, and then we started looking at other options. Now, I think this is the unfortunate part. While you simplify, you miss out on being able to invest. Now, at the same time, I want to be practical, right? That yes, you need to see if you can save higher taxes, and if the new tax regime helps you save higher taxes. To that extent, ideally, the discipline that we require on our side becomes very, very critical, right? So you from your side as an investor need to say, you know what, I will save, say, anywhere between 15 to 20%, say, of my take home, and I can do it through mutual funds. And even though, there's no tax saving, I think it's still good to do it. Uh, yes, if you have a house and you need to compute it, and in the home loan and stuff, then you may look at the old tax regime. But I think today, in most cases, the new tax regime is likely to be more beneficial. So I would still take advantage of it, but then you have to be very disciplined to ensure that you have savings. And just to give you an example, for all of us, I think tax was the starting point. But then, once you get into a savings habit, then you start looking at other options. The good part about the younger generation is they also more, informed. So to that extent, they are aware about mutual funds and the availability of information, the popularization of the popularity of, let's say, SIPs, etc. I think is something which is good. So I'm hoping that we are disciplined enough to take advantage of things.
One more question, since we're talking about strategic financial planning, and you're a master over here, I also want to understand now for employees, who are earning between almost 12.75 lakh to 14 lakh. Now, how would you recommend, how can corporate NPS contribution help in maximizing their tax liabilities over here?
Yeah, so rather, I think how to optimize, the tax liability, right? So I think uh, it is NPS is definitely one tool that corporates can use. Okay, and I think from that standpoint, both in terms of ensuring that your basic is there, so as high as possible, and to that extent, you also are able to take a higher NPS. In fact, that's something that we are doing in for our own employees. So I think that is something which I think companies can take advantage and help employees.
One last question, and then later on we'll move on to our question answer session. Since we are talking about retirement planning, I want to understand how are employers structuring their salary packages, to align with the new tax regime and NPS benefits, and also, since we are talking about long-term implications, how does the shift to the new tax regime and increased NPS contribution affect the long-term retirement planning? Are there any potential drawbacks or consideration employees should be actually aware of before making the switch? What would you guide?
Yeah, so I think actually there's no harm in being able to do a higher NPS, right? So to that extent, one has to relook at the components of salary, and your basic has to accordingly be there, and then you can do 10% of that and stuff. Okay, so that is something which you can sort of take advantage of, and companies can help structure it accordingly. Yes, I think as time goes by. You had, the PF, Provident Fund, which was an important way to, build your retirement capital. NPS is now becoming the other alternate. Okay, of course, the flexibilities today that the Employee Provident Fund is giving, and allowing people to also have, I think, 1,800 rupees contribution, etc. Okay, that is also taking away forced savings that is coming from employees, and many of them are choosing to go for that at a lower employee provident fund contribution. But the second part of it is yes, I think from here NPS is definitely a good option. NPS also, the good part of it, I think, will deliver better than even your EPF returns, especially if you have a component of equity. If you're doing it monthly and you're doing it long term, then I think it definitely can take up a good component, or build up a good corpus for yourself, for you to set up your retirement. So I think it's going to be definitely a very good tool. The NPS is also a low cost item, low cost investment avenue. So that is something that definitely all employees need to take advantage of. But from what I can hear, the penetration is not yet there. So like we had with SIPs, and there was a lot of knowledge that people got. I think from here, how do we educate employees, investors, etc., to be able to take care of this one thing, and be able to build up a capital for themselves.
I think that's all about how individuals who have enrolled into a new tax regime or who are thinking the onboarding to be done in the new tax regime should be very careful about their financial goals, especially goals at retirement, for which you must have invested in instruments like a PPF, PF you must have had the benefit over there, NPS your contribution also had a benefit. So it's very important to stick to those financial goals even without getting a tax benefit. But then let's move on to our question answer session now. Anil, and let's take Dev's question. He says that he's 48 years old, sending the question by email from Bangalore. And current portfolio value is roughly around 4 lakh, and he plans to keep investing till almost 10 years. Goal is just wealth creation, no specific amount target. He would want your recommendation in terms of any portfolio changes or fund changes. Parag Parekh Flexi Cap 2,000 rupees as a blue chip from Canara Becco, again 2,000 rupees SIP going on. Same amount SIP in Kotak Multi-Cap, ICICI Blue Chip, Edelweiss Mid-Cap, Axis Gold Fund, Mahindra Manulife Aggressive Hybrid, Baroda BNP Paribas, BAF 2000. All right, quite a diverse portfolio, but then do we need so much of diversification? And also he's talking about having 10 years. An aggressive hybrid is good enough, but then can we just have either of them? Maybe an aggressive hybrid and a pure balance advantage fund. I mean, what would you recommend?
Yeah, so I think, many times it depends on how you're constructing your overall portfolio, and it's important to look at it that way. Uh, and if you're, let's say, using some of the equity, mid caps, small caps, etc., I think then, it's good to have some hybrid, which sort of manages risk better for you, right? And uh, if I look at it from that way, and if I have to choose between aggressive hybrid and, let's say, balanced advantage fund, I will still go with today a balanced advantage fund, more from a point that it manages risk, right? And what's a balanced advantage fund? Basically, it's what you call as a dynamic asset allocation, where the debt and equity components are dependent on the market valuation. So if market valuation is higher, it goes into debt. And so it then safeguards your portfolio from market fall. And the vice versa as well. When markets fall, then it goes into equity and it allows you to take advantage of possible, market moves upwards. So I think it manages this well because, if markets are highly valued, then it is more into debt and the fall is lesser, right? So it'll fall probably lesser than even an aggressive hybrid, which has a standard equity allocation, right? So from that standpoint, I would definitely go in for the balance advantage fund, and I think that is a option that he can go ahead with.
All right. One more question on behalf of Deb that I want to ask you. Any other addition in terms of a fund, a new fund, because he also has to step up his SIPs, right? What kind of fund would you recommend him to add on, maybe say in 6 months down the line or whenever he's planning to step it up his SIP?
Yeah, so I think, see, broadly, one needs to look at the overall and also what is your risk appetite, okay? Because if you step back and see, in the past, okay, mid caps were doing very well, so everybody went, after mid and small caps, and that has seen the highest volatility, right? And what we are seeing is, and not only for him but for most others, I'm saying, we are finding that portfolios have been skewed towards mid and small caps over the last period of time. So from that standpoint, I think, also keeping in mind today, the way the valuations are a lot more attractive on the large cap side. So I would possibly go and put my weight, on that side. And one could either use something like a large cap fund, even say a Nippon India large cap fund can be one option there. One can also go back and say, okay, if one wants to just not be very active, then one can go back to a flexi cap fund and possibly there a product like flexi cap. The only point to him is that there's no point in adding too many funds. Okay, so it's possible that you may just go back and add weights to funds that you already have.
All right, let's take Mr. Nag's question now. This is again via Hyderabad. And he's planning to hold on to his mutual fund portfolio for 15 years, expecting 2.5 CR. And okay, a weekly SIP from Jan 2025 and stopped SIPs after Nifty crossed 23,200 levels in April. Parag Parikh Flexi Cap, he's investing in HDFC Flexi Cap, Nippon India Large Cap. Now, due to high valuation in small mid cap, he's invested very less in these funds, which is Motilal Oswal Mid Cap, Invesco Small Cap, Bandhan Small Cap, Quant Small Cap. And he's invested 23 lakhs 65,000. Right now, the portfolio shows 1 lakh 25,000 profit on 23rd April. He's planning to invest more 12 lakhs in market correction. What would you recommend if he should be having more smaller mid-cap funds in his portfolio? Are they all aligned to his financial goal? And can he also move some money in large and flexi caps, from large and flexi caps to small and mid caps to achieve his goals? I don't know why he's so obsessed with small cap and mid caps. I think that is one theory with most of these people, or at least our viewers. When they send us the question, they just have mid cap and small cap in the portfolio. And Mr. Nag is also trying to time the market. I don't know whether there was any reason for him to stop his SIPs. I do not have him on the phone line because I really want to ask this question to him. See, being a direct stock investor, you try to time the market, you want to stop your investments, you want to stop your SIPs, it still makes sense. But when you are a mutual fund investor, the strategy is totally opposite, Anil. Where all do you think Mr. Nag has gone wrong?
Yeah, so I think, let me say, where all maybe he can look at certain perspectives rather than saying what he's gone wrong,
Okay.
right? So,
Yeah.
so I think one of it is definitely I wouldn't stop an SIP, right? Because it's very difficult to time it. You may get it right sometime, but a lot of the time, you may find that market is run away and you missed it out, right? So, and we've repeatedly seen that timing the market is more important than trying to time the market, and SIPs do a fantastic job of it out there. Right. So I think I looked at his portfolio and see, in terms of invested value, he's invested very less in mid and small caps. In the other flexi and the large caps, etc., are where he has substantially higher ones, which is why I think he's saying, can I invest in mid and small caps higher? So I have no issues with that because it doesn't make sense. He has some of them at 8.5 lakhs, and some of the funds at 20,000. So it makes sense for him to also add up to the mid and small caps. And since there's a correction, it may not be a bad idea from here. Okay, and that will through an SIP mode is what I would suggest. SIP is all I would suggest. In fact, one thing, since he has lump sum, I think he should consider an STP, right? So at least for part of it. So rather than trying to time it again, yes, maybe he got it right this time, and markets have fallen. Okay, but it's not necessarily always the case, and because you may lose out many times. So I think for getting into even his mid and small caps, and especially mid and small caps, I would do a slightly longer STP, somewhere like 9 to 12 months for the money that thing. So I would think start off
Okay.
more long-term SIP, and if markets
Right.
fall, then come and switch a larger extent.
Sure. Sure. All right. I think with that, it's time up on the show as well. Thank you so much for being a part of this show and helping our viewers with their financial strategies today, investment strategies today. Thanks. And for the viewers, time to sign off, but I'm going to leave you with our WhatsApp number and email ID. Thank you so much for watching.